Welcome to the Everything Financial Radio Show on the Legacy Radio Network. I'm your host, Dennis Tubbergen, and we are here every week at this time. And I'm awfully glad you decided to listen in today. We've got a great show lined up for you. Dr. Bob McHugh of TechnicalIndicatorIndex.com will be stopping by today and give us his thoughts on the direction of the markets, tell us about his analysis, and he's going to tell us about his means of analyzing markets, and I think you'll find it very interesting. It's a great perspective. Dr. McHugh is one of the hardest working technical analysts in the entire industry, and very pleased to have him on the show today. Also, if you're on Social Security, this past week was a pretty important week for you. The government announced the amount or level of the raise that you can expect to get on your Social Security benefits this next year. Pretty important. How is that calculated? We're going to get into that in the last segment on today's show, and you won't believe the way some policymakers have changed the rules. I know that comes as a surprise, but certainly stay tuned. We'll be talking about that on the last segment of today's show. Also, we'll be talking about what is going on in China here in just a moment. A Chinese banking official has said that there are products being sold in China that are the equivalent of a Ponzi scheme. And in our show's second segment, South Dakota beats Harvard. I'm not talking about a football game, but you'll want to stay tuned and listen to this really remarkable story. If you've got a child or grandchild going to college, I don't think you'll want to miss this. Quick reminder, if you've not attended one of our discovery groups, you can get information at personallegacyseminars.com. Couple dates coming up. November 1 up at Railside in Byron Center. Stonewater Country Club on November the 8th. Personallegacyseminars.com is where you go to get more information. Also, investingapproach.com is the site to go to request your 2012 guide, Surviving a Market Crash. This is the last week we'll be offering that guide. So go to investingapproach.com. We'll send you the 2012 market guide. It contains all of our analysis, sources, our forecast for where the markets are going and how it might affect your nest egg, and some strategies that you might consider. That's at investingapproach.com. You know, before Dr. Bob McHugh stops in, I want to take just a quick minute or so and share with you a bit from an article that was actually picked up by Reuters News Service on October the 12th. There's a Chinese banking official that actually said that some of the off-book wealth management products offered in China are like a Ponzi scheme. Now, this statement was made by a gentleman by the name of Mr. Zhao Gang. He's the chairman of the board of the Bank of China, and the Bank of China is one of the top 4 state-owned banks. And he wrote an op-ed in the English-language China Daily last week, Friday. He said that the music may stop when investors lose confidence and reduce their buying or withdraw from wealth management portfolios or wealth management products. Essentially, and he said to some extent this is fundamentally a Ponzi scheme. Well, essentially these wealth management products don't clearly specify the underlying assets. So I wouldn't say that is like a Ponzi scheme. I would say it's definitely a Ponzi scheme. And Mr. Gang admits in his article that wealth management products have been sold that are not tied to any specific security. In other words, investors just provided the capital and didn't ask where the money was going to go. That's the epitome of a bubble, and we are in an economic winter season. Certainly that will lead to some banking issues in our view. I am pleased to have back on the program with me Dr. Robert McHugh. Bob is probably one of the hardest working market analysts that I think I've ever met. I have read his stuff for many years, and if you're a longtime listener to the program, Bob appeared on the show about a year ago. So, Bob, welcome back. It's nice to have you.
Thanks, Dennis. Great to be back.
Bob, there's a lot going on economically speaking. Let's start with the obvious. By the time this interview airs, there will be a little more than a couple of weeks left until the election. Given where we are economically speaking, does it matter who gets elected?
I think the big issue as far as who gets elected will be probably 2 points. One would be tax policy, and the other would be ability to compromise on fiscal matters such as budgets and the tax issues. So from that perspective, it's hard to say at this point who would be the better candidate to accomplish a good tax policy and a good fiscal policy for the country. It all depends on how well they can work with the other party and this kind of thing. So it will make a difference. I do believe that once the U.S. Presidential election is over and the Senate's decided in the House, that they'll be in a position for the first time in a couple of years to really sit down and get to work on the fiscal side of our economic problems and hopefully put together constructive plans to get the economy going.
So, Bob, there is this fiscal cliff that's been talked about in an ominous sort of way that if Congress doesn't do something, that we are going to have tax increases, and I have seen various figures as to what the dollar impact will be, but I've seen some figures that say this is going to be a $600 billion hit to the economy. How important is it to avoid this fiscal cliff, given the delicate state of our economy now, in your opinion?
I think it's absolutely critical. I've seen estimates that if they do not avoid this fiscal cliff, we could see another 2 million people lose jobs. I think there's so much business uncertainty, so much uncertainty in planning and budgeting for growth in a particular business, in each business, that they just don't know what tax policy is going to be. They don't know what regulations are coming down the pike. They don't know if it's going to loosen or get tighter. And so to solve the fiscal cliff is really critical. The Bush tax cuts are scheduled to end in a couple of months. And if that ends, that's effectively a massive tax increase. The unemployment tax rate reduction from people's withholding pay is scheduled to end. And if that doesn't get renewed, we're talking about taking more money out of the pockets of Main Street, out of individuals and small businesses. And if we take money out of people's pockets at this very time, it's just going to make things extremely difficult and make matters much worse. I think the economy could really sink much further than it has recently.
Well, Bob, in the next segment, we certainly want to get your take on where the markets are going based on your analysis, and we'll talk in a little more detail about your analysis. However, I'd like to get your take on what impact the actions of the Federal Reserve will have moving ahead. We've engaged in, well, I shouldn't say we have. I had no part of it, neither did you, but the Federal Reserve has engaged in 2 rounds of quantitative easing. They've now announced that they will literally print $40 billion a month in new money to buy mortgage-backed securities to try to get the economy moving and maybe pump up the housing market. My reaction is it seems like we've already tried this and it hasn't worked. What's your take?
Same thing, Dennis. I agree with you 100%. The first program, QE1, didn't have much impact, and QE2 had even less, and QE3, its law of diminishing returns, will not have as much either. The problem with QE is that it's printing money out of thin air, and the money goes to buy government or mortgage-backed securities from Wall Street. The cash passes from a printing press at the Fed into New York City, into Manhattan, into Wall Street, and the money's pretty much staying there, or it's being used to buy up the stock market or pump up commodity markets. The Wall Street firms are trading with the money. The money's not trickling down to households, to individuals, to small businesses. The money's locked up in high tower buildings in New York City, and it's being used to pump up inflation. Because what are they going to do with all that cash when they sell other securities to the Fed? Well, Wall Street's going to buy something, and what they're going to do is they're going to buy gold and metals and grains, and they're pumping up the price of commodities, which is causing inflation to increase, causing the cost of living to rise. And that's all that's being accomplished. It really isn't a method to get money into the hands of households and small businesses, which is what this economy needs in order to be to start growing and to improve.
Bob, in the time we have left in this segment, we've got a couple minutes. You mentioned that this printing of money causes inflation, and I've interviewed a number of other experts on the program. Harry Dent and Ian Gordon come to mind. they both tend to be in the deflationist camp. And when you look at certainly wages, when you look at housing prices, there certainly seems to be a deflationary trend. But then you go to the gas pump in the grocery store, and quite the opposite appears to be the case. So how in your mind do you reconcile these two things? And would you characterize yourself as someone who is an inflationist, or would that be a mischaracterization?
I think it depends on the asset that we're talking about. The problem with QE3 is it causes certain assets to go up in price, which causes inflation, which I just described, the commodities, gasoline, oil. That is rising, and those are necessary ingredients for so many of the things that we use every day in our everyday lives. So those prices are going to rise, food, energy. And at the same time, it's not doing a darn thing to help the housing market. So the problem in the housing market is people can't come up with the down payment money anymore to qualify for a mortgage, because they used to be able to get the down payments from the sale of their existing home or other sources. So you see a depression in the housing market. That's not going to get any better from QE3. So you kind of have a dichotomy here. You have some assets dropping. I think the stock market's going to drop, and so stocks will drop. I think housing, of course, is dropping. You have that deflation side of the equation, but you also have simultaneously an inflation side to necessities, and that's what makes it. It's like the worst of all worlds.
Well, in the next segment, Bob, we certainly want to get your take on, you mentioned that it's your belief that stocks will drop, and certainly we want to get into some of your analysis and some of that work in the next segment. If you are just joining us, we're chatting with Dr. Robert McHugh. We will be continuing our conversation with him in the next segment here on the Legacy Radio Network. We hope you'll stay with us, and we'll be back after these words.